All right, I was at a crypto conference recently with Matt McClintock of Bespoke Group, and we were talking to some prospects and clients and talking a little bit about the estate tax threshold and why it might make sense to start planning now. And usually in my videos, I'm explaining crypto, blockchain, Bitcoin topics to those that don't necessarily understand them, but now I'm going to go the opposite way and explain kind of an estate planning technique to those in the crypto world and really those in the traditional finance world that don't understand this. Now remember, I'm not an attorney, I'm not your financial advisor, I'm not necessarily telling you you should do this, so those are all the disclaimers. I'm not telling you you should, I just want to explain how this works because sometimes we get into the weeds and don't necessarily come back and explain it all. So I'm going to try to do it in a relatively short amount of time. Here is an estate tax planning technique, and this is mainly for the high net worth, ultra high net worth individuals, families, whatever they might be. And we're going to talk about some planning for appreciating assets or assets you think will go up in value. So here's the way kind of the estate tax works in the United States. So the day I die, when you die, when I die, whatever, I'll make you die because I kind of don't want to die right now. So the day you die, what's going to happen is the US government, the IRS, is going to take stock of everything you have. They're going to go, what is the value of all of this stuff that you have? And that can be your house, that could be your brokerage accounts, that could be money you have in the bank, that could be private companies you own, whatever it might be. They're going to take stock of everything you have. Okay, and I'm going to not talk about if you're married, if you pass it, if your spouse gets part of it. I'm just going to, in general, here's how it works. They're going to take everything you have and they're going to go, all right, everything above it, everything below this estate tax threshold, everything on this side, I'm going to assume this is below the estate tax threshold, your family, your beneficiaries get to keep 100% of it. Everything on this side, meaning above the estate tax threshold, currently they are going to tax 40% of it. So your family, your beneficiaries, whoever, get to keep 60% of it. Okay, so if you die today and you are worth, we'll call it $100 million, currently the estate tax threshold is $13.61 million per person. So I'm going to assume now you're just a single person. So what that says is everything above and beyond that. So 13.61 million your family or your beneficiaries get to keep for free. Everything above that, which is currently 86.39 million, they are going to tax 40%, and your family gets to keep the remainder. Okay, that's how the estate tax works. That's how the estate tax threshold works. Currently, again, the estate tax threshold this year, 2024, is $13.61 million. It will go up next year, indexed for inflation, in 2025. At the end of 2025, that law will sunset. That means theoretically it will end unless Congress puts in a new law. And when it does, this 13.61 million here will be reduced to $5 million per individual, $10 million per couple. Remember, this 13.6 million is per person, so if you're a couple, you get double that. So that's how it works right now. Everything below that, your family gets to keep free and clear of taxes. Everything above that gets taxed at 40%. Very basic. Now, you might be thinking, okay, well, I'll just get rid of everything on my deathbed. I'll just give it all to my family. I'll give it to my kids, whatever. I'll sign whatever I need to sign so they get everything. But aha, the government knows that trick. They're not going to let you do that. So instead of just taking everything you own, they're going to take everything you own the day you die, plus everything that you've gifted. If you gifted something away, if you gave it to family and friends during your lifetime, they're going to tax that as well. And how do they know that? Because as you gift things, as you gift especially large chunks of money, you have to file gift tax returns. Now, that doesn't mean you pay taxes as you do it. It means they're just kind of filed away with the IRS until such time as you die. So if you've given away, we'll call it $10 million in your lifetime, and you die tomorrow, the government's going to say, okay, you have $100 million plus you gave away 10, so we're going to tax you on $110 million. Or we're going to say $110 million is your total, The first 13.61 doesn't get taxed. Everything above and beyond that gets taxed at 40%. They know that trick of giving away everything on your deathbed. So how do we solve for that? Well, what we do is we make sure that we gift away some of that money now, but in a way that it's going to grow outside of your estate. So what do we mean by that? And that's where this kind of trick comes in. And again, I'm not going through all the details. There's details as far as how much you can give away per year before you have to file a gift tax return and all those things. But I'm going to assume, or not assume, I'm not going to talk about those things because that's way, way, way too detailed. Okay, so what we're going to do is kind of throw things over the gifting fence, if you will. Okay, so what we're going to do is over here, we're going to set up this kind of wall. So here's everything that's inside of your estate, everything that you own personally, and that can mean you and your spouse have a brokerage account. That means you and your spouse have invested in private companies. Maybe you have an LLC that invests, but if you own all of that LLC or you own all of that company that then does the investing, doesn't matter. They're going to take the value of all that. So what do? We start throwing things over this wall. So you might take this year, for instance, you might go, look, I'm worth, I don't know, $25 million or something personally. Let's just say you're worth $25 million. So what you can do is if you're worth $25 million, you might take $13 million and throw it over this wall, gift it over this wall. And that $13 million can be anything. It could be cash, it could be stock, it could be real estate, it could be private companies you own, it could be crypto, it could be Bitcoin, it could be ETH, whatever it might be. It could be tokens that are worth virtually nothing that you think will go up. It could be private company equity, public company equity, whatever it might be. You can throw it over the wall. And over here, now it ends up in a trust. And this is called an irrevocable trust or irrevocable trust, however you want to pronounce it. Now, irrevocable means you don't get it back, right? You can't take it back. So what happens is, let's say you throw $13 million worth of assets over into this trust, and let's say you're relatively young, you're in your 30s or 40s or whatever it might be. Now, you now have $12 million here. Hopefully you're able to live your life on $12 million. You have $13 million over here in this trust, in this irrevocable trust, by the way, which is outside of your estate. Again, I'm not getting into all the nitty-gritty details here. $13 million here. Now let's say in your lifetime, this $12 million that you have now grows to, let's say $50 million. Remember, you're young, you're still investing, whatever it might be. This 13 million, let's say, grows to, let's say, we'll call it the same 50 million, okay, because they're going to grow at, I don't know, relatively similar rates, let's say, during your life. Now, you might go, okay, I'm dying with the same $100 million that I did before, but here's the difference. Here's where it gets fun. So now you die, the government says, look, you have $50 million plus the $13 million you gifted away, you have $63 million. What are we going to do? We're going to tax the first 13.61. Again, I'm assuming you're dying today, and you've done this a while ago. We're going to tax the first 13.61 million. Your beneficiaries get free and clear. And so what's left there is roughly $50 million that gets taxed at 40%. Well, that's significantly less than when we taxed $87 million almost at 40%, significantly less. So your family is going to get 60% of this 50 million, so 30 million plus 50 million. So now your family is going to get a total of $80 million because we put appreciating assets into this trust. We put 13 million of them here. They grew to 50. You add the 30 you get here, and what you end up with is $80 million left to your family, plus this 13.6. I'm sorry, I forgot that. So $93.61 million goes to your family. That's how we do this estate tax planning. Now you go, okay, what do I lose there, right? Because the government gives you something, they always take something away. And what they take away is control. Because when you have an irrevocable trust over here, part of what they take away is you can't have control over those assets. Okay, so we'll talk about control in just a minute. But first, let's talk about what assets you might throw over there. You might throw over there something that you think will appreciate. It doesn't help to throw cash into the trust. One, we'll talk about control in a minute, but you can't really spend it on yourself. But two, you want to throw something over there that you think is going to go up significantly in value because you want this 13 million to grow. So if you think Bitcoin's going to go up, or ETH is going to go up, or whatever tokens you have, or private company equity, or whatever it might be, you're going to throw that over the wall into the trust so that it can grow outside of your estate, meaning you're going to leave your family so much more money. So that's part of the planning. Now, again, what are they going to take away? Well, when you throw assets over the wall into this trust, you have to give up some level of, that's giving up control. Not all control, but you have to give up some level of control, because you have to be able to defend to the IRS the fact that once I put this into this irrevocable trust, it wasn't really mine. In the case of some assets, it's, I don't have the ability, if it were, say, a brokerage account, I don't have the ability to sell those stocks and take the proceeds. Okay, in the same with crypto. I don't have the ability to actually trade those assets and then go use them, or go buy something with them that I'm going to necessarily use myself. Now, there are ways to engineer the trust such that you will be able to live in a house that is owned by an irrevocable trust or something like that. Now, in the crypto world, where it's a little bit different, is we talk about control. We talk about not your keys, not your coins or something. But what you have to do if you're going to give up control, you are going to have to give up the keys. That's a big deal in the crypto world. You're going to have to give up the keys, because if you have the private keys, then the government is going to make the argument, and they're probably going to win, that you then have control over those assets. So when you put assets over here into an irrevocable trust to get them outside of your estate because you want them to grow so that your family can be the beneficiaries, you have to give up the keys, and that's where you look at like qualified custody. Right? You need qualified custody in this. And qualified custody, obviously, it could be in the US, it could be in other jurisdictions like Switzerland, Liechtenstein, the Bahamas, Singapore, places where if you park assets with a custodian like a hybrid bank, they have the keys, but the regulations are such that they don't get to commingle those assets on their balance sheet. They're not part of the bank balance sheet, they're actually yours. And in this case, they're assets of the trust. And again, you've had to give up some level of control, meaning maybe you can be the investment manager, but you can't necessarily be the person who affects the trades. You can't actually get assets out of that trust into your own personal bank account anymore. So that's part of the estate tax planning that we look at. And so when you hear estate planners talking about the estate tax threshold, how it's going to go at the end of 2025, it's going to go from 13.61 million indexed for inflation next year. So it might be 14 million or a little bit less, something like that. It's going to go down to $5 million. That's a big deal. That's a huge downgrade. So between now and the end of 2025, if you have this level of wealth, if you have above 5 million and you think that that is going to appreciate significantly, again, this could be private companies. You might be investing in some sort of AI companies. You might be investing in small businesses. You might own a significant amount of crypto. That's where you move assets outside of your estate. And again, this is where there becomes a balancing act, because once you move assets into this trust and make it irrevocable, you can't necessarily live on this money anymore. So you have to make sure, if you're worth $13 million right now, you can't throw all 13 million over the wall, because then you're not going to have the opportunity to have any money to live on. So you have to continue to be able to live on your money. And if you've made $13 million in your lifetime, you're going to want to live like you have that level of wealth. So you're not going to necessarily live in a small apartment so that you can have all your assets outside of your estate for the benefit of your beneficiaries. You want to enjoy your wealth, but part of the enjoyment of your wealth is knowing that this isn't going to be eroded by estate taxes later. Now, you can have some control over the trust. You can, be the investment manager again, but you can't be the one that takes distributions. You can't be the one that affects trades, things like that. So that's why, but that's also why you throw appreciating assets over into this trust, assets that you think will go up in value significantly. You move them to qualified custody. So that's a little bit about the estate tax planning that we look to do for those that have that are high net worth or ultra high net worth. Again, if you're even in the $10 million range, which I know seems like a whole lot of money, but I know there's so many people in the crypto world or even in the tech world, even in the investing world, whatever it might be, that have that level of wealth. Now is the time to start doing that planning. You at least have to talk to some sort of estate planner. You at least have to talk to someone who knows how to deal with high net worth or ultra high net worth individuals, because you have to start going down the road of, does this make sense? This doesn't make sense for everyone. Again, if you're really young, if you have a family, if you have a lifestyle you want to keep up, you can't move everything into an irrevocable trust. But if you're really concerned about wanting to make sure that your beneficiaries are going to get a good portion of what you've accumulated or what you've built or what you think you're going to build, now is the time to start at least thinking about planning, because as we get into 2025, there's going to be a rush on estate planners, on CPAs to value those assets. Now, what you also can do once these assets are in this irrevocable trust, remember, is you get to kind of set a lot of the rules for this trust as you create it. So if I have kids, if I have beneficiaries, and eventually maybe I'll have grandkids or something, I can set some of the rules such that this is relatively safe from creditors. I have a daughter, for instance. If I say, look, my daughter has access to some of this money after I die, but if she gets married, her husband, her spouse will not necessarily have access to this unless she gets a distribution and commingles it with him or her. So that's where you get to set some of the rules. So not only are you doing it for tax purposes, but you're doing it for asset protection purposes, because this is outside of your estate. If this is a horrible example, but if I die, and when I die, I have caused a car wreck that has created a significant amount of financial damages, these assets are outside of my estate. If people sue me for wrongful, for death or for damages or something, sue my estate, this, remember, is not part of my estate. I've saved this for my family. Okay, I've put rules in place. My daughter can't get to necessarily all of this money at once and go spend it. She can't go blow it on an investment or blow it traveling the world or whatever. She can only get maybe a certain amount per year. Her spouse can't necessarily get to it. If she gets sued, if my wife gets sued, anything like that, they can't take this money. They can take whatever is in their estate, in part of their ownership, but they can't take this. So the estate and tax planning is again for tax planning. I want to make sure that my wealth doesn't get eroded by taxes from the government after I die. And right now I have the most I can ever in history move outside of my estate into a trust today. Next year it'll be a little bit more, and after that, unless a new law comes into place, that law gets sunsetted and we move down to $5 million. But I can also somewhat control this from the grave, meaning my family is not going to lose this because this is in a trust that is outside of their estates as well. So that is part of the estate and tax planning that we look at, and why it's important to kind of get started now, because as assets appreciate, for example, if I have, we'll call it, $50 million worth of Bitcoin right now, $50 million worth of crypto, and I want to move 13 million of it out, $13 million worth of Bitcoin out today, but I don't get around to this planning until next year, and Bitcoin goes from where it is today at 70,000 to next year it's at 140,000. Well, I can only move half as much Bitcoin next year at the time that I've kind of started this process. Granted, I have much more wealth, but I can only move half of that outside of my estate without being subject to estate taxes. Now, I can move much more than $13 million outside of my estate, but if I move, say, $40 million outside of my estate, then remember, that's going to be a gift tax return, and everything above and beyond the 13.61 million is still going to be subject to the estate tax. Now, it can still grow outside of my estate, but it will still be subject to the estate tax. So again, usually I'm explaining crypto to the traditional finance people. Today I'm going backwards and explaining some of the traditional finance and estate planning that we do to those that are in, you know, mainly in the crypto and tech investing world, so you understand when we have some sense of urgency here, why we have this sense of urgency. It is currently June of 2024, so you have approximately 18 months left to get this done. And again, at the end of 2025, there's going to be a rush to get it done. So now is the time to start doing some of this planning. But again, these are conversations that I had, Matt McClintock and I had at Consensus at a crypto conference recently, and I wanted to make sure that I got it across to as many people as possible so you understand why we have a little bit of a sense of urgency and understand it's time to go talk to your financial planner, it's time to go talk to your estate planner, it's time to talk to Bespoke Group, whatever it might be, about this type of estate and tax planning.